A suspense account is a temporary general ledger account used when the trial balance fails to agree and the exact cause of the imbalance has not yet been identified. It enables the accounting process and financial statement preparation to continue while investigations into recording or posting errors are undertaken. The suspense account is therefore an important error correction mechanism within the double-entry bookkeeping system, ensuring that accounting records remain balanced until discrepancies are resolved. The program emphasizes understanding the purpose of suspense accounts, identifying the types of errors that create them, recording transactions within suspense accounts, and preparing correcting journal entries to eliminate suspense balances before the final financial statements are issued. 1. Purpose of a suspense account. A suspense account is a temporary ledger account created whenever the total debits and total credits in the trial balance do not agree. Under the double-entry bookkeeping system, \boxed\text, total debits equals total credits. If this equality does not hold, the difference is transferred temporarily to a suspense account until the underlying errors are identified and corrected. The principal purposes of a suspense account are to allow preparation of a provisional trial balance, maintain the equality of debit and credit totals, isolate unexplained differences pending investigation, facilitate systematic error correction, provide an audit trail for unresolved accounting discrepancies. The suspense account is therefore not a permanent account and should always be cleared once corrections have been completed. 2. Errors leading to the creation of a suspense account. A suspense account arises only when an accounting error causes an imbalance between total debits and credits. Typical errors include single-sided entry. Only one side of a transaction has been recorded. Example: a cash payment has been credited to the bank account, but the corresponding debit to rent expense has been omitted. The trial balance will disagree. Arithmetic errors. Errors may occur when adding ledger accounts or transferring balances into the trial balance. Incorrect totals immediately create trial balance differences. Unequal journal entries. A journal entry may contain unequal debit and credit amounts. Example: debit equals $5,000. Credit equals $4,500. Difference equals $500. The trial balance will not balance. Posting errors. Only one side of a journal entry may be posted to the general ledger. The missing posting creates a trial balance imbalance requiring investigation. Incorrect ledger balancing. Ledger accounts may be balanced incorrectly or carried forward with incorrect totals. These errors affect trial balance equality. 3. Errors that do not create suspense accounts. Many accounting errors preserve debit-credit equality and therefore do not require suspense accounts. Examples include errors of omission, errors of commission, errors of principal, errors of original entry, complete reversal of entries, compensating errors. Although these errors affect financial statements, they do not produce trial balance differences because double entry remains mathematically complete. 4. Recording entries in a suspense account. When preparing the trial balance, any difference between debit and credit totals is transferred to a suspense account. Example: total debits, $580,000. Total credits, $576,000. Difference, $4,000. To balance the trial balance. Credit suspense account $4,000. The suspense account temporarily represents the unexplained imbalance. Similarly, if credits exceed debits, the suspense account would receive a debit balance. The balance remains until investigation identifies the underlying error. 5. Correcting errors using the suspense account. Once errors are identified, correcting journal entries are prepared. The suspense account receives the missing debit or credit necessary to restore proper double entry. Example 1. Missing debit entry. Equipment purchased for $3,000. Bank correctly credited. Equipment account omitted. Correction. Doctor equipment $3,000. CR suspense $3,000. The suspense balance decreases accordingly. Example 2. Missing credit entry. Revenue earned. Sales account omitted. Cash correctly debited. Correction. Doctor suspense. CR sales revenue. The suspense account now contains the missing credit. 6. Clearing the suspense account. The objective of error correction is to eliminate the suspense account completely. Suppose the suspense account contains credit balance $5,000. Errors identified. Missing debit $2,000, missing debit $3,000. Corrections. Dr. Expense $2,000. CR Suspense $2,000. Dr. Asset $3,000. CR Suspense $3,000. The suspense account balance becomes zero and is closed. A suspense account should never remain open after all errors have been corrected and before final financial statements are issued. 7. Importance in internal control and financial reporting. Suspense accounts contribute significantly to accounting control by identifying incomplete postings, supporting systematic investigation of accounting errors, preserving trial balance equality during correction procedures, facilitating external audit verification, preventing inaccurate financial statement preparation, strengthening the integrity of accounting records. Although suspense accounts provide temporary balancing, management remains responsible for identifying and correcting the underlying causes promptly. The suspense account is a temporary accounting mechanism used when the trial balance fails to agree because of incomplete or incorrect double-entry recording. It allows accounting records to remain balanced while investigations into posting and arithmetic errors are undertaken. Through systematic identification of discrepancies, preparation of correcting journal entries, and eventual elimination of the suspense balance, accountants ensure that the general ledger, trial balance, and financial statements present a complete and faithful representation of the entity's financial transactions. Consequently, suspense accounts play an essential role in maintaining the accuracy, reliability, and integrity of IFRS-compliant accounting systems and financial reporting.